How to make extra money right now. FDIC-insured certificates of deposit are a safe and attractive investment. FDIC-insured CDs are safe because they are insured up to $100,000 for an individual account. They are attractive because they pay a stable interest rate that generally doesn't fluctuate during the term. FDIC stands for the Federal Deposit Insurance Corporation and was established in 1933. It was started during the Great Depression to boost confidence in banks. Various attempts had been made prior to that, but from 1929 to 1933 9,000 banks ceased operations, resulting in losses of $1.3 billion. As a point of reference, there are currently about 471 FDIC-insured banks in the U.S. and its territories. Certificates of deposit are considered a time deposit. You agree to let the bank keep your funds for a period of time from 30 days all the way up to 20 years. Most popular terms are from 1 year to 5 years. In exchange, the bank usually offers to pay you a higher rate of interest than you would receive in a plain savings or checking account. Generally, the longer the term of the certificate of deposit, the higher the rate. However, as recent as 2005 and 2006, many banks have been using the internet to attract additional deposits through high-yielding savings accounts. Many of these high-rates accounts offer a teaser rate equal to a 1-year or 2-year CD, but shortly after dropped the rate to be more in line with a 90-day CD. For instance, throughout June 2008, AARP through Huntington National Bank was offering a high-yielding money market account at 4.50%. The bank took in millions of dollars in deposits. Currently the rate is 3.50%. That is a very significant decrease, especially for folks that deposited considerable amounts of money. On the other hand, FDIC certificates of deposit protect your rate for the duration of the term.